Okay, today we're going to look specifically on the PSDS platform, the stress test. What we do here is we change the probability distribution function from normal distribution to Cauchy. So briefly what that means is in normal distribution, and most of the models that are created will use normal distribution, the bell-shaped curve with two standard deviations, representing most of all occurrences, and it's the theory of large numbers. It's a useful way to model things. We apply it to lots and lots of things in the finance world and in other branches of research and science. Um, However, we also know that some things don't behave normally. In particular, returns on markets. Things like extraordinary events, the 87 market crash, 1929 market crash, the 1998, long-term capital management, currency debacle, the 2000 tech bubble burst, the 2008 Great Recession. These things statistically aren't supposed to happen as often as they do under normal distribution, but they're considered to be 5 or 6 standard deviations or sigma events. So why do they happen so often? And how do we account for that when we say we build a portfolio and we're looking at the possibilities of extreme valuations in a portfolio? So we created a stress test. We essentially changed the distribution from normal to Cauchy, which accounts for more extreme behaviors in portfolios. And here there are no mean returns or standard deviations. So that's our stress test. Let's start with a portfolio. I randomly picked some ETFs, threw them in evenly, say, let's use this portfolio. If we were using this allocation with this portfolio, we can look at 3-year, 5-year, or 10-year stress tests. And each period carries a different kind of environment. So it's good to look at all three of them in combination and see how the portfolio's stress test changed. So let's start with 3-year. I just collect 3-year, hit stress test, and we send it out, and our simulator runs a million trial simulation. And what we're looking for is we're collecting all 1,000 different annual percentage rate returns for 1,000 different allocations of that portfolio. Each portfolio run in 1,000 Monte Carlo simulation. And the idea is we're going to look for here the negative return components. How often did that portfolio come up with a negative return? And more importantly, or just as importantly, how many times was there an extreme event where it was negative and it was very negative? We've run thousands and thousands of these, and our experience is in various portfolios of various designs that there seems to be a grouping of numbers. From 0 to 75 negative occurrences appear to be a relatively decent portfolio, good kind of outcome. And you can see we've created a scale here, and it comes back as it's in the green, 46 negative outcomes. Had it been higher, it would move down the scale here and get into the red zone. And it just suggests you got to take a closer look at the component parts. That's for 3 years. And if I want to see the actual chart, I bring it up here, and right below, I can see, yeah, almost all were positive and not alarming. And there's only one extreme, so pretty good stress test. So we wonder, that's a passing grade, say, for 3 years. What about 5 years? Does this portfolio stress test change as we step into a longer period? And change the data for 5 years. Again, we know that there can be a trending period for 1 year or 3 years, but as we get longer, 5 and 10 and 15 and 20 years, we start to group into the long-term behavior of investment classes. Collect the good and bad events and find out what their mean return was over that longer period. That's why we suggest you look at the stress test. Part of it is to see how it behaved as time periods shift. The other part is to try and project forward, saying, our assessment is the near future, the next 3 to 5 years are like the last 3 to 5 years, or the next 3 years look like it's going to be more like the last 10 years. And you can start to base your assessment of the portfolio design on that. Here we are 5 years at 67. So you can see we picked up a little bit more negative outcomes. We look at the chart. Again, mostly positives, a few more extremes, not super extreme, but a few more. So again, not terrible outcome. It's in the acceptable range. Good. We're okay. And does it shift when we go to 10 years? I don't know. We'll run it. Each time we run it, it takes about 50 seconds to get the information back. Remember, we're running a full scan, and we're delivering it back right to the grid. Um, when you run these scans, keep in mind that once it's there, you can hit the print button down here, and it will print the grid and scan results. And you can save that by naming the file and save it to a folder. And say, okay, I see what 3, 5, and 10 years looks like, and keep a record of those. It helps as you're redesigning and rebalancing to look at the past iterations of your portfolio. Now, 6 months later or a year later, you're updating data based on the trailing 3, 5, and 10. And what's changed? All useful information. It can be done on the fly within a few seconds and store the information and then bring it back for comparison. So here we see in 10 years, as we pick up the 10-year results, and let's look at that. 21 is in our red zone, so let's shift the data out 10 years. And what's going on? We see that the rates of return here on some of the assets are very low or negative, and the standard deviations are very high, especially relative to what the return was on some of them. So that is suggesting that, hey, maybe some of these component parts are a little too volatile to be working in conjunction with the rest. Maybe we have too much of that. And that's starting into what we see is draw for concern. And you can see here, again, more negative concurrences and more extremes. So we find that to be useful information. It suggests we have work to do on this portfolio. That's how we interpret it. This is available to you as a user of our Platinum package. And here we go. I wanted to show you the print feature. If I open that stress test and hit the print button down here, what you see happen is saves as a PDF. There it is. So you can see, and had you named it, the name would be right here in the URL line. So there you go. I'm going to cancel this. And that's a discussion on Cauchy stress test. One other thing to note, here you are looking at the detail of the 1,000 iterations. But if you have more questions, you can pop open this white paper. It's an inset PDF. And we wrote an explanation of how we calculated it, what Cauchy is, and what our scale is, and how we came up with it. And just a sample. Hopefully you'll find this to be useful and another arrow in your quiver as you compete for business and are trying to do a better and better job for your clients in managing their money. Thanks again. We'll talk to you next time.